Better, I'm back. Than ever, I'm back. You f***ers, I'm back.
All right. Today is Friday, March 25th, and this is a Friday night special. In this video, we're going to talk about a macro topic, in this case, the comeback of natural gas. Now, I wish I was able to produce this video yesterday or perhaps earlier than that, but it was impossible. It is what it is, better late than never. And the reason is the stocks that I'm going to talk about in this video, which was supposed to be produced yesterday, all of these stocks popped significantly higher today. The call options alone gained significantly today, and these stocks, in my opinion, haven't seen the end of the gains yet. But I'm also glad that I shared the list with you on Twitter and also in a post here on YouTube. I hope some of you at least saw that, and I know some of you did, because you told me that you bought some of these stocks today and you enjoyed some gains. So I'm glad to hear that, but let's go ahead and discuss why I like these stocks and which ones in specific. We're also going to talk about the fundamentals driving natural gas higher. So without further ado, here it is, in focus tonight. Heat it up, baby. Natural gas is going higher, rising from the dead. Why? You might have heard that we have this war that's been going on over in Europe. I don't know if you heard about it or not. We have this small continent we call Europe, which is poor in resources. And next to it, we have a much bigger continent we call Russia, which is rich with resources. And the bigger country invaded the smaller country, and basically that's wrong. I'm just trying to channel my inner Kamala Harris. But anyways, as you can see, the European continent, specifically countries like Poland, Finland, but specifically the most important country in Europe, all due respect to the others, Germany, and Germany happens to be highly dependent on Russian natural gas. And it has been a concern throughout this war and even before the war started. What if Russia cuts the supply of natural gas to Germany? What if Germany has to let go of Russian natural gas supplies, which is for now impossible. But if that scenario happens, we would see massive increase in natural gas prices here in the United States. Why? We already know that European gas prices are surging out of whack. This is not a surprise to anyone. But why would U.S. natural gas prices move higher if we have a disruption of gas supplies from Russia to Germany or a cutoff entirely? I want you to think about that, and I think the answer is clear. Let's play a puzzle here. I'll give you the answer in a little bit, but this week, Russian President Vladimir Putin came out and said that unfriendly countries must pay in rubles for Russian natural gas supplies. We know what he means by that. It's Germany. Putin also added that the collective West has killed all trust in their currencies, as he demanded that all of these European countries pay Russia in rubles for natural gas. And immediately, the Russian ruble recovered not all the ground it lost since the war, but just a teeny bit. That is enough to give Putin the boost that he needed. Also, the Russian stock market bounced higher. It opened finally after a month of being closed under many restrictions. But regardless, the Russian stock market bounced higher. And now Russian tycoons recovered over $8 billion of the wealth lost since the war started. So obviously we're sticking it to the Russians. And here comes the German chancellor, and he pretty much dismissed Putin's demand to pay Russia in rubles for natural gas, and he pointed out that there is a set contract that demands payments in euros. The problem is the chancellor is under a lot of pressure at home. A lot of lobbying groups are warning that cutting Russian natural gas supplies to Germany could have, quote, incalculable consequences. It would also jeopardize EU unity and its ability to act economically and politically. And therefore, Germany is now demanding advance warning if the Russians are about to cut natural gas supplies to the country. And of course, it's not just Germany. The entire European Union is under pressure right now. You've been calling Russia criminals and Putin a murderer, yada, yada, yada. Yet you continue to buy his gas and fueling his war machine. And now the Europeans are starting to feel ashamed and perhaps under pressure to let go of all Russian natural gas supplies. So what is the alternative? Let's listen to the EU commissioner, whatever the hell she is.
With our new proposal, Repower EU, we can speed up this transition even more. First, by fast-tracking renewable projects, this is a strategic investment in our security, including hydrogen and biogas. Second, by speeding up investment in energy efficiency. Everyone can contribute in reducing our dependency on Russian gas. And third, by diversifying our gas supply away from Russian gas towards reliable suppliers. Tomorrow, I will discuss with President Biden how to prioritize LNG deliveries from the United States to the European Union in the coming months. We are aiming at having a commitment for additional supplies for the next 2 winters.
So it is kind of hypocritical, right? She says we have to focus on renewables. That is actually the core of the problem. The green energy lunacy that got us here to begin with. Number 2, she's advocating for European citizens to cut down on spending, cut down on how much they're driving, cut down on the amount of electricity used, and so on and so forth. Temper your expectations. Take your standard of living down a notch. Do it so we can stick it to Putin. Meanwhile, we continue to buy Russian natural gas. But perhaps the third and most important thing that she said she's going to talk with President Biden about U.S. liquid natural gas as a replacement to Russian natural gas. Now, it is easier to transport natural gas via pipes. It is really hard and challenging to replace that logistically and otherwise via ships. And we're talking about an insane amount of ships that will be sailing pretty much every single day from the US to the European Union. But the Europeans are now getting desperate. They have to do it. They have to find an alternative to Russian energy supplies. And the US is here. Which brings me to 2 points. When they talk about natural gas as being dirty and we have to transition to renewable energies and green energies and yada yada yada. All of a sudden now you like natural gas? All of a sudden now natural gas is clean? We've been saying this all along. And they want the natural gas to be dug here in the United States and sent all the way to them. It's the same thing of the Western hypocrisy of this whole green energy thing. Western countries want to live in a so-called carbon-free environment, clean air, the virtue signaling, but in doing so, they're exporting all of that pollution to poorer countries, where lithium, nickel, cobalt, and many other metals are produced. It is the kind of environmental colonialism, shall we say. But regardless, the Biden administration responded right away, and they said, Europe, you asked, we deliver. We're going to give you all the natural gas that you want. Not when the American people were complaining about higher energy costs. The Biden administration did not move to increase natural gas supplies. But when the Europeans ask, we have to bend over backwards and dig natural gas. Look at that picture. The chancellor's like, we want some natural gas from America? And Biden's like, huh? Who's that, man? Is that Putin? No, sir. This is the German chancellor. Oh, come on, man. I love The German Bachelor. My favorite show. Not a joke. Not a joke. Anyways, and now even bankster Jamie Dimon of the Landromat at JP Morgan Chase, who was anti-fossil fuels and was advocating for green energy crap, now he's pressing Joe Biden to increase the domestic supply of natural gas. Not to relieve American citizens from higher energy costs, but rather to bail out the Europeans out of their dependency on Russian natural gas. Now, what does that mean? It means that we will see the capacity of natural gas production in this country increasing dramatically, because now we have to satisfy the domestic demand of natural gas. But not only that, but now we have to supply the European demand entirely. We're talking about the entire Russian supply of natural gas has to be removed and replaced by, let's say, American natural gas. You put 2 and 2 together, this would be good for this country, huh? Cha-ching, baby. War is good. It's going to be really good for natural gas producers in this country. Here's a list for you. We have Southwestern Energy, Chesapeake Energy, Range Resources, Coterra, EQT, CNX, Devon, and EOG Resources. There are many natural gas suppliers in this country, be it shale or otherwise. But the crown jewels of American natural gas supplies come from 2 states. Number 1, Texas, for granted of course, but most importantly, the Marcellus well in Pennsylvania. And as you can see from the map, Pennsylvania, Texas, the highest reserves and production of natural gas in this country. So we're looking for companies with presence in both Pennsylvania and Texas, because if we need to ramp up the supplies dramatically and on a short notice, then we have to be in stocks of companies that have presence in both, and they can ramp up the supply right away. So let's do this exercise and go through these companies one by one and see where the operations are. Let's start by Southwestern Energy, SWN. They're mainly concentrated in the Appalachia, which includes Pennsylvania. They also have presence in Louisiana, which is not bad, but it would have been better if they had operations in Texas. No biggie. What about Chesapeake? This company was pretty much in shambles just a few years ago, but what a difference a few prints of cocaine from the Federal Reserve make. They revive all of that energy trade. Now you sprinkle Biden's anti-energy policies and you got the best environment to be energy investor. And we talked about that even before the election, by the way, in this channel. Anyways, when we look at Chesapeake, they have presence all over the place. They have presence in Texas. They have presence in the Marcellus Shale. They have presence in other areas too. So far, so good. What about Range Resources? They're concentrated in the Appalachia again, Pennsylvania. So that's good, but no presence in Texas at all. Now, what about Coterra? Coterra has presence in the Permian Basin. They also have presence in the Marcellus Shale in Pennsylvania and the Appalachia. They also have presence in the Anadarko Basin in Oklahoma. So far, I'm liking Coterra more, and I'll reveal, by the way, which name of all of these I own in my portfolio. Now, let's look at EQT. They have presence in Marcellus again, but they also have presence in the Utica. So far, so good. No presence in Texas, but no biggie. What about CNX? Again, presence in the Appalachian, Pennsylvania, and Utica, but no presence in Texas either. But this company has more involvement in pipelines. What about Devon Energy? They have presence in the Eagle Ford in Texas, but it's mostly oil. They also have presence in other territories, but if you're looking for sort of a hybrid play, oil and gas, then Devon is a good choice. Lastly, what about EOG Resources? They have presence in Texas, in Colorado. They also have presence in the Trinidad and Tobago. So we have at least a background on the operations of these companies. We can do extensive research, and I can produce 200 pages worth of research for you, but you gotta pay me for that, so we're not gonna do that here. What we're gonna do here instead is look at the technicals and certain statistics because, well, let's just go and start with the technicals. But before we talk about these individual companies, let's cover the ETFs for those of you who like to buy ETFs. In this case, we're talking about the FCG, this is the natural gas ETF, and this is a weekly chart, by the way. As you can see, we have resistance at around 24.67, and the chart knocked at that once, twice, a third time. It was support before it was resistance, and now the chart managed to break above that line. Is that bullish or bearish? The answer is clear. It is bullish. So if this chart pulls back, you probably want to pick it up because you might say, I might have missed this one, Maverick. Maybe it's too late. Maybe, but I don't think so because when you zoom out to a monthly chart, for example, for the same ETF, the last time around we saw natural gas prices spiking to these levels, and oh, by the way, oil prices spiking to these levels, even below these levels, all of these energy stocks were trading significantly higher. So even after the impressive rally that we got so far, we're talking about certain companies in the energy sector gaining 40, 50, 60% year to date. Even with that, they remain undervalued, in certain cases severely undervalued, given where the commodity is trading. Now, let's talk about these individual names, and we start with SWN, Southwestern Energy. This is a weekly chart. Once again, as you've seen with the ETF, we have 615 as an important level to watch out for. This level acted as support before it became resistance, not once, twice, third time, fourth, fifth, sixth, doesn't matter, multiple times. And finally, this week, we have the breakout. Now again, is this bullish or bearish? The answer is clear. It is bullish. So do you just buy these stocks based on the technicals? You wait for dips and then you buy them? Perhaps, but you might want to include some fundamental analysis in your picks. The problem is if you use the income statements and the earnings, you're not going to get anywhere. And the reason is the numbers from last year are depressed. And here's an example from Southwestern Energy. The numbers are going to look inflated. They're going to look so good, but out of perspective. So looking at the earnings and the income statements is not going to be helpful in this case. What is helpful though is looking at the balance sheet or perhaps the debt-to-asset ratio, because the main concern with all of these gas companies is the amount of debt. We want the cleanest out there. The debt-to-assets ratio, for example, measures the amount of debt that the company has on its books versus the value of the assets the company owns. The lower the ratio, the better, because the value of the assets are much higher than the value of the debt. The higher the number, the worse. So in this case, we have a ratio of around 0.47. Not bad. How about this one? The the ticker SHK Chesapeake. This is a daily chart. It has been on a trend. This stock, by the way, was a disaster before it was relisted again. But so far, so good, and it is moving higher and higher by the day. Is it going to pull back at some point to the trend line? Yes. But who's to say that the chart's not going to move to higher prices, perhaps above 100, before it moves down and reaches that particular trend line? When we look at the debt to assets ratio for this company, it is 0.21, a lot better than SWM. This is also after the restructuring, so you got to be careful with this company. Next, we have the ticker RRC, and this is for Range Resources. This is a monthly chart, by the way. And as you can see, the chart is showing a saucer bottoming formation, which is a powerful bottoming formation. We have resistance at around 44. The stock is not even trading around that number. On top of that, look at last time around, 07, and even all the way to 14, when energy prices were this high. So for you guys who are going to say, maybe I'm too late for this trade, my rebuttal is, last time around, when energy prices were this high, look at where the stock was trading. Back in 07, for example, it was trading above 70 bucks a share. It is nowhere near that price right now. So the stock is severely undervalued. Now you might say, well, what about the debt? Maybe back then the balance sheet was a lot cleaner, giving the company higher valuations. Let's look at that. You look at the debt to assets ratio, it is 0.40. We have technology companies that the retail crowd is stampeding to buy right now that have debt to assets ratio of 5. 6, and in certain cases more. Here's another one, the ticker CTRA Cotera. This is a monthly chart, and as you can see, we have support, solid support, at around, let's say, 15. The chart, if it wanted to break below that number, could have done that long time ago, but this level held on over and over and over and over again. We also have a sloping line of resistance, and recently, this month, the chart managed to break above that sloping line of resistance. This is a bullish breakout. You look at the momentum indicators, they're not even that extended as we've seen with other charts. So I really, really like this chart, and I've been liking it for a long time, by the way. And here is the debt to assets ratio. Look at that, 0.17. You cannot get any cleaner than this. This company is coming back in a big way. Now you factor in the fundamental tailwind of substituting Russian natural gas to European countries, and this stock could go much, much higher. Next, we have EQT. Look at this chart. It's a monthly chart. We have the level of 26, acted as resistance, and then acted as support over and over and over and over again. So we know that this is an important level to watch out for. Any break below could produce a flush down. Any break above could produce a massive squeeze higher. We also have a sloping line of resistance that has been going on since 2014 when energy prices crashed. Now, energy prices right now are higher than they were back in 2014, yet the stock is nowhere near where it was trading back in 2014. That tells you it is severely undervalued. Look at what happened to the sloping line of resistance, by the way. The chart went all the way and started to bottom. It made a reverse head and shoulder formation, a bull flag pattern, a saucer bottoming pattern, a donkey's ass pattern. Doesn't matter to me what you call it. You now have the visual ability to distinguish between topping and bottoming formations. And the chart since then has been making higher lows. And then came the break above 26 once and for all this month. And boy, it is an explosive breakout. Now, what do you do with this? It's going to get technically overextended at some point, at least from a daily chart perspective, for example. The chart could pull back. This will give you an opportunity to hop in and join this momentum ride higher. Now, let's look at the debt to assets ratio for this company, EQT, and it is around 0.26, a lot better than a lot of names that we went through, but not the best. What about this one, CNX, and this is a weekly chart. The important level to watch out for is 18.49. It acted as resistance over and over and over and over again throughout the years. This week came the breakout, and therefore we're seeing this impulsive move higher. Yes, it's going to get overextended. We will see a pullback, but that pullback will be worthy of buying because the chart is in a bullish breakout. When we look at the debt to assets ratio, it is 0.28, not bad at all. What about this one? Devon Energy. The important level here is 51.75, and that level has been broken before. And this is, by the way, a monthly chart. And as you can see, the chart went down and it retested 51.75 and it rebounded higher. Now, it is becoming a little overextended, specifically on the RSI indicator, which means the stock could probably stall on a daily basis for a little while, but sooner or later, this ride will continue to go higher. Because again, last time around, we've seen these energy prices, the stock was trading well above $100 per share. Right now, it is not even closer to $100 a share, not even half of that. So once again, the company is severely undervalued. When we look at the debt to assets ratio, it is around 0.32. And by the way, in extensive research, we're not just bounded to the debt to assets ratio. We look at operating ratios, we look at liquidity ratios, we look at performance ratios, and even after you do all of that, these ratios right now, today, are a lot better than 2014 when these stocks were trading at double the prices they're trading at right now. So that tells you they're severely undervalued. And here's the last stock we have, EOG Resources. This stock has been performing a lot better than the rest because it bottomed a long time ago. You can see the double bottom, and this is, by the way, a monthly chart. And after the double bottom, the stock has been going higher and higher and higher and didn't look back at all. We're now looking at 133.5, which is the former high. I believe the stock will make it all the way there, and then it might pull back. And as you can see, when we look at the RSI or the MACD indicators from a monthly chart perspective, they're not overextended yet. They might be overextended on the daily, perhaps the weekly, and we could see pull back on daily basis. That is granted with any stock. But again, the long-term picture for the stock remains intact. Now, when we look at the debt-to-assets ratio, it is around 0.15. And this is a clean ratio. You're not going to find a lot of stocks in the market with this level of debt-to-assets ratio. So again, in conclusion, we have a bear market. All in all, at least in the indices, specifically in the software, maybe chips, technology, the high beta, high momentum, high valuation names. A lot of stocks are down 50, 60, 70% from the highs. But you see stocks like this amidst a so-called bear market, and they continue to move higher and higher and higher. This is the bull market right now, and it continues to perform consistently. So what is the need to chase meme stocks and garbage stocks and bounces that could fade away after the gamma squeeze is done? Why do that when you have consistent performance? At some point, all of this is going to fade away, but until then, you ride the ride higher because inflation is not going to stop. The Fed is way behind the curve, and the geopolitical tensions are changing the game. For example, even if we have a ceasefire agreement between Russia and Ukraine, or even a peace agreement, we're not going to just normalize relationships and trade with Russia as it used to be before. Russian natural gas will be substituted, at least for now. And who is going to substitute that? US-based natural gas producers. The tailwinds are intact, and we went over the technicals, we went over the debt, and so far, so good. And by the way, my pick, the stock that I own in my portfolio, is Coterra. After doing the research, I like Coterra. Let me know in the comments which one you like. And is it too late to hop on the rally of natural gas? I'd love to hear from you in the comments. And with that, folks, I'm done here. This is all I got for you for this video, but rest assured, we're going to go over all the developments in the stock market throughout the week in Sunday's video. So stick around for that. But until then, I got to say goodbye. Thank you for listening. Thank you for watching. I will talk to you again on Sunday.